Okay, so this question is asking us to distinguish between three different types of debt, and it's focusing in on mezzanine debt and asking why mezzanine debt typically comes with high interest rates. So mezzanine debt, if you remember, is generally a junior form of debt. So it's way down the ranking. It's usually unsecured. And it may have special features added to it to encourage the investors. It may have convertible features. It may have interest that is rolled up and paid at the end. But it's basically not your standard safe form of lending. And mezzanine itself as a word means in between. And we can think of mezzanine debt as being kind of in between your nice, safe, secure debt and your much riskier equity. So that really drives us into the correct answer there, which is B. It's to do with the ranking and status in the company debt structure, i.e. there's only really the shareholders who are taking more risk than holders of mezzanine debt. It is not the reliance on leverage because, and they're all forms of debt, and debt is leverage. So that's not really a correct answer in there. That's more, it's more that leverage can magnify the returns for equity investors. It's not really something that you would apply to debt usually. And the need for management involvement over an extended time, that's more about the distressed debt investing, isn't it? Where rather than being thought of as kind of the baddies, the corporate vultures, it's more that people can buy the distressed debt and over a longer time period that may end up being converted partially to equity. And it may be that there is a future for the company. It's not necessarily about asset stripping and closing companies down, but that is not a short-term investment, is it? And so C would be the correct answer if you were referring to something to do with distressed debt. But no, mezzanine debt, it is answer